For the average investor, the stock market is an engine of anxiety. You sit staring at a chaotic web of red and green lines, constantly refreshing your screen, hoping to predict tomorrow's outcome by analyzing the jagged price movements of the past. Looking for a sense of security, you turn to annual reports. But these documents are highly polished marketing brochures, meticulously crafted by corporate public relations teams to highlight the triumphs and quietly bury the flaws. Driven by the fear of picking the wrong horse, the default strategy is extreme diversification. You spread your savings across 30 or 40 different companies you barely understand, praying that a few winners will offset the inevitable losers. Crunching historical math and reading public corporate marketing only tells you where a company has already been. To figure out where it is going, you need an entirely different toolkit. In 1958, Philip Fisher published Common Stocks and Uncommon Profits. He argued that hyperfixating on balance sheets was a trap, and that an investor's real edge came from qualitative, boots-on-the-ground investigation. This approach became the blueprint for some of the greatest capital allocators in history. It served as a major foundational philosophy for Warren Buffett. Fisher believed that to achieve massive market-beating returns, you have to stop acting like a human calculator and start operating like a private detective. The true engine of a business never appears on a quarterly earnings statement. This value is hidden entirely off the balance sheet, requiring you to investigate the people making those numbers happen. Fisher relied on a technique he called scuttlebutt. While conventional analysts sat in offices calling CEOs or reading Wall Street projections, Fisher bypassed the executive suite entirely. He went straight to Main Street to find the unpolished truth. He built his intelligence network by talking to the company's suppliers, surveying its customers, and interviewing the competitors who feared them most. Crucially, he tracked down former employees to see what was happening behind closed doors. This targeted corporate gossip uncovers operational reality. It reveals supply chain bottlenecks, internal chaos, or brilliant unreleased product lines months before the financial press catches on. Fisher organized his scuttlebutt research into a meticulous 15-point checklist. To make it actionable, those 15 criteria can be distilled into 3 essential pillars of investigation. First is the growth engine. You want a business funneling cash into ruthless research and development, paired with a hyper-aggressive sales team to push those new products to market. This is exactly how a company like Motorola dominated the early television industry. Second is people and culture. Fostering great labor relations and promoting from within creates deep institutional knowledge. It prevents costly union strikes and keeps top engineering talent from defecting to rivals. Third is the deal breaker. Absolute, unquestionable management integrity. If an executive brags loudly about a great quarter but buries bad news, or if they find ways to enrich themselves at the shareholders' expense, Fisher's rule is absolute: walk away immediately. This rigorous screening is how you identify an enduring organization and discard the ones that simply had a lucky quarter. Once you actually find a company that passes the scuttlebutt test, you face a new problem. To reap the rewards, you must actively ignore conventional Wall Street advice. Take dividends. Wall Street loves a high yield, but Fisher viewed it as a negative signal for a growth stock. If a company is handing you cash, it means they have run out of highly profitable ways to reinvest that money back into their own operations. A management team that retains that cash and uses it to expand their market dominance creates compounding growth. Over time, that continuous internal expansion generates vastly more wealth than a quarterly dividend check. Then there is the myth of over-diversifying. Fisher argued that owning 5 deeply researched, outstanding companies is significantly safer than owning 30 companies you know absolutely nothing about. Conventional rules protect the average investor from total ruin, but they also guarantee perfectly average returns. Breaking the standard playbook is the only path to uncommon profits. If you execute the grueling detective work up front, the final phase of the strategy shifts. The hardest part of the entire process is actually doing nothing. Fisher famously stated that if you have done your research and bought an outstanding company, the best time to sell your shares is almost never. It's incredibly tempting to hit the sell button because a stock's price feels too high, or because a geopolitical war scare sends the broader market into a panic. But macroeconomic fears and temporary price dips are noise. An investor should only sell if the company's internal culture permanently rots, or if its core growth engine breaks down. Every ticker symbol represents a specific collection of individuals working toward a goal. Once you identify brilliant innovators and honest leaders, buy your stake, step back, and let them go to work. True wealth is built by doing the heavy lifting up front and then letting exceptional people